Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Steve Sosnick, Chief Strategist at Interactive Brokers, to discuss ramifications of the debt limit. And we're also going to learn about the January effect. Steve, it's great to see you as always. Welcome back to Trade Talks.
Thank you so much, Jill. It's a pleasure to join you as always.
All right. Thank you so much. And the U.S. debt ceiling, it's such an interesting event because even though there are impacts to the markets and the economy, you think that it really is a political event at the end of the day.
Oh, absolutely. We wouldn't be in this situation if it wasn't about politics. It is purely politics. It's sort of an artificial number. Historically, the debt ceiling is a relatively new invention, within the last 100 years or so, as opposed to having always been there in the history of the Republic. It's somewhat at odds with the 14th Amendment because it says that the U.S. is always going to pay its debts. So there's this weird political gamesmanship that goes on, and it goes on periodically, and it comes up every few months to every couple of years, depending on how the politics get worked out. This time, and the next few words I'm about to say are always the most dangerous for investors and traders. This time it feels different. Most of the time, we know it's political theater. We've seen this movie before. We go to the brink, the last time we actually went over the edge a little bit was 2011, which actually led S&P to downgrade the U.S. from AAA to AA plus. The problem now is it's fairly clear that we have a very tight, very tight majorities within both the House and the Senate. And within the House, you have a much more fractious caucus, shall we say, among the Republicans. And so there are some demands being thrown around that the Democrats are in no mood to meet. And so this definitely feels like it's going to be a bit more of a prolonged fight. Ultimately, I do think the U.S. pays its debts. But in the meantime, getting to that process could be a bit fraught. You look at a couple of days like Friday and today, however, and say, okay, the market doesn't care. And to a certain extent, we've seen this movie before, and we know how it ends. It usually ends okay. But the question is, what happens when we get there, and what ramifications might there be if there is a temporary, something that makes a temporary impediment to the U.S. paying its debts.
Mm-hmm. And you brought up a great example to kind of humanize this a bit in your newsletter, that there's two people on a credit card account. Person A gets the bill in the mail. They are at the max. Person B doesn't want to raise that debt limit. However, they need to buy things for their household. And it's this back and forth where it's a really hard compromise to come to. So if you think about it on a household level now, times that by trillions of dollars, you could see why this is a problem.
Yeah, I mean, I typically don't love, when you hear politicians say, well, if I were a household, I would do this, and, households have to do that. Households don't get to print money. Let's put it this way. They don't have people paying them taxes. They pay taxes, don't receive taxes. So I didn't want to stretch the analogy. You can find it. I wrote literally a one-act play. You can find it on tradersinsight.news. I called it Much Ado About Something. But basically, the problem you have is the debt ceiling. The argument is politically about spending, but the money's been spent. Congress allocated the money, and you can argue back and forth over whether they should have or shouldn't have, but it's been done. It's an obligation. The debt's there, and also to a large extent, it's interest on that debt on spending that had been approved over the past, however many years. And so it's very difficult. That's why I go back to why it's political, because you're conflating indebtedness with spending, and the problem is the indebtedness is largely the result of spending that has either occurred or has been approved at some point in the past, and so it's very tricky to have to sort of hold the economy hostage over this sort of stuff. But this is the country we live in, and it's a weird little feature of our system of government. I'm in no power to change it. I can only react to it. I can only try to explain it, whether it's good, bad, or indifferent.
Yep, just one of many. Let's move along to, I think the market has a lot of self-fulfilling prophecies. Sell and go away is one of the ones that we're more familiar with. Explain to us what the January effect is.
The January effect is a sort of, after I just talked about all the political quirks, January effect is sort of a result of the tax code, actually. The idea is that people are incentivized to take losses prior to a calendar year ending. And so what you see is a lot of times a disproportionate amount of selling into year end. Now that hasn't really been a big issue in a lot of the prior years because people, for the most part, were making money, and so you're not really incentivized to reap your gains before the year ends. As a matter of fact, you're more and less incentivized to do it after the calendar turns because then you don't have to pay those taxes till the subsequent April. Any losses you take in December come off the coming April's taxes. And so what happened was, in 2022. For better or worse, a lot of people had a lot of losses to take. It was a difficult year for many. And so what we saw was a lot of tax loss selling in a lot of very popular, well-known names. And I think what we're seeing now is the January effect, meaning that the selling is behind us, and it's now that we're ripe to rally off of that. It's gotten quite extended, but think about some of the moves that we've seen in things like Amazon and Meta, which are among the market leaders on the way up. Those were some of the most prominent stocks that got clobbered in 2022. So you had Meta losing 2/3 of its value and Amazon losing 50% of its value. A lot of money came out of those, to recognize tax losses in December. And as a result, those are two of the better performers that we're seeing in January. There's plenty of other factors for why we're rallying into January, but I think we really can't discount this January effect, which is that we can get oversold in December and then get a bit of an outsized bounce in January as a result, sort of the opposite reaction.
All right, now bringing up some of those large cap tech names there. Thoughts on the Nasdaq 100? I mean, we did have an outsized move so far to kick off the year, but to your point, we had a massive valuation reset for a number of reasons. What are some of the current levels that you're looking at here?
I'm sort of a moving average guy, and so I want to see Nasdaq recoup and sort of, I'm going to say, catch up to S&P 500. That becomes a big secular question. Tech had been the monstrous outperformer, and as we both know, NDX is really it's tech heavy, and I consider it probably the best proxy for big cap tech that there is. But we sort of fell out of love with growth stocks in 2022. So I want to see us recoup. It's less about the levels, but then can NDX catch up to SPX? One of the things you and I have talked about in the past is that the NDX and SPX, S&P 500, tend to correlate rather well. Just NDX has a higher beta. It's a more volatile play, and we've discussed in the past that if you want to express a secular move in the market, NDX is usually the better way to express it if you're looking to capture it from a trading point of view. And so that's really how I want to view it. The other thing I'm looking at here is how we're still not seeing a lot of activity but not much of a premium placed on wings. We still see, that I look a lot at the VOLQ VXN spread. We've gone over how they're constructed differently, but essentially that the differential between the two, I use as a proxy for how much, fear there is about wings, whether it's an upside move or a downside move, and they still tend to be trading at a relatively tight spread, which means that people really are focused on at-money options and at-money volatilities, and that seems to be the trend that we're following for now. And let's see if NDX plays catch up, especially with earnings beginning this week, and some of the NDX leaders, Microsoft, by the way, which Microsoft has sneaked back into first place in NDX, passing Apple. With Microsoft leading it off, Tesla this week, and then the bulk of the big caps in the following week.
All right, Steve, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.